massive changes are coming to the 401k. I mean, huge changes are coming to the 401k, especially if you're a high income earner. Really big changes that could affect your retirement plan substantially. If you're over 50 and you're a high income earner, I can't believe they're doing this. Let's dive into it. Hi everyone, my name's Thatcher Taylor. I'm the owner of ProPath Financial, and I'm gonna help walk you through catch-up contributions and the huge changes that are happening in our 401k landscape. Thanks government, Secure Act 2.0, they're always changing stuff on us. Jeez. So this change was slated for 2024, but they just came out, thank goodness, in August because it wasn't completely clear, and they're changing this and they're moving it back to 2026. But because I'm a planner, I love to plan. We're planning for this with my clients for 2026. And the change is how you get to utilize your catch-up contributions in your 401k, and especially if you're a high income earner. So let's first talk about what a catch-up contribution is. All right, if you work for an employer and you have access to a 401k, the main catch-up contribution is for people over the age of 50. You can put in additional money into your 401k from your paycheck as an elective deferral. I'm not talking about after-tax money or putting the maximum amount into 401ks. I'm only talking about the elective deferral, which for 2023 is $22,500. But if you're over the age of 50, you get to put in another $7,500, which means $30,000 can go into your 401k from your paycheck as an elective deferral each year. So why all the hubbub with this change? Because the point of the 401k is being able to take a tax deduction and get tax deferral, or put more money in an after-tax bucket and get tax deferral. Here's what I mean. If you electively defer $22,500 or use the catch-up of the additional $7,500 if you're over the age of 50, and that all was to go pre-tax, you would get a $30,000 tax deduction essentially, where if you make $200,000, you only have to pay tax on $170,000, and that may potentially go away. Well, I shouldn't say may potentially, it is going away in 2026. That $7,500 is now gonna have to go to the Roth. The other option is your elected deferral, your $22,500 could go into the Roth initially, and that would be great because now you're paying the taxes now on the initial income, but that money grows tax deferred depending on what it's invested in, so it all comes out tax-free in the future. So you're not gonna save money now, but you're gonna save money later, and you could do that with the catch-up, where you could decide, regardless of your income, if you wanted the catch-up to go pre-tax or post-tax. It's up to you. That option's gonna be gone in 2026. Now the change is that catch-up is mandatory. It's now gotta go in the year 2026 into the Roth 401k portion, whereas before it could go pre-tax. No more current year tax deduction. This is massive for retirees. I think the IRS just wants more revenue. They want to be able to tax you a little bit more now, but that's a whole nother thing for later. So under Secure Act 2.0, if you are the age of 50 or older and you make at least $145,000 from the prior year, your catch-up contributions are going to have to go into a Roth 401k. This rule will not apply to you if you make $144,999 from the previous year. It will not apply. And so this delay was supposed to happen next year, so it's not happening until 2026. Just keep that in mind, but you got to start planning for it now. So let's talk about the value Roth IRAs. So this change might not be such a terrible thing. Roth IRAs have huge upside if you want long-term benefits. Here's a big one. Roth distributions do not affect Medicare surcharges in retirement. Traditional income or distributions from tax deferred accounts or accounts that were already taxable will. Distributions from Roth IRA accounts, as long as you don't break the rules, or Roth 401ks are tax-free, and they don't affect your income taxes at all. You can pull $10, $20, $100, $500,000 out of a Roth 401k, and you would have to pay taxes at all as long as you don't break the rules. There's no required minimum distributions. Your spouse receives the money completely tax-free. They can spend it completely tax-free. Then the money will pass to heirs tax-free, and they can spend it tax-free. They got to distribute within a certain amount of time, but they can distribute as well tax-free. So there are massive benefits to the Roth 401k. So not all is lost with this change. I just want to say thank you to everyone. Thanks for watching. I appreciate it. I really hope you're starting to plan for these big changes. This is one thing that planning does, is it helps to prepare for changes that are outside of our control. The government is going to do what the government is going to do, and we don't have a ton of control of it after we vote on it. So make sure you're building this stuff into your retirement planning journey so you can make good decisions and you know how the decisions affect you years and decades down the road. Please make sure to like and subscribe. And if you need a financial planner, go ahead and click below to get started. I'm a fee-only fiduciary and I can't wait to help. Thanks for watching.